You want to know the uncomfortable truth about dollar cost averaging? And do you want to know what your financial advisor is not going to tell you? He's not going to tell you that it's going to feel like you're losing a lot before you actually start winning. And that is the uncomfortable truth about dollar cost averaging. You feel like you are losing for a long period of time, and then suddenly you're winning, and then you're winning, and then you're winning, and then you're winning some more. So I wanted to break down this concept in a very simplistic manner, purely because there's so many people talking about it, but they don't really give you the ins and outs of what it actually feels like, right? You know, money is a very emotional thing for a lot of people, and departing with that money and then seeing the value of that money decrease is not a great feeling, right? And that's what I want to actually address in this video. So dollar cost averaging is basically buying some stock, right? Never go all in. You buy a little, and then you buy a little bit more, and then you buy a little bit more. But this happens, right, as the stock is actually coming down. This is why it's called dollar cost averaging, because you are lowering your average cost base of what this actual stock is going to cost you in the end. Now, you are always striving to actually have 100 shares of any equity. Why 100 shares, Ricardo? Well, once you have 100 shares, you can then go and write covered calls up against those specific shares and make weekly income. Yes, I said weekly income. When I say this to people, they're always like, oh, but yeah, how do you make weekly income off your Apple stocks? And I'm like, it's easy. Let me show you how, right? And it's through a mechanism called covered calls, which, you know, seems complicated, but it is not, right? Let's say you're starting your portfolio and you want to dollar cost average on a dividend paying stock. And why a dividend paying stock, Ricardo? Well, because you're getting paid the dividends for holding that specific stock every single quarter. You're dollar cost averaging. And when you get to 100 shares, you're actually going to be able to rent out your shares and make additional weekly income. This is exactly what we teach in the Wealth Triangle strategy. Okay, so you are wanting to dollar cost average on PEP because PEP's a great dividend paying stock. And when you started dollar cost averaging on PEP, it was roughly about $150, right, per share. You dollar cost average at that specific point because when you looked at the technicals, it looked like PEP was actually going to be bouncing, right? It was trading within a range. So you bought 25 shares at $150. PEP continued to slide, right? This is the losing feeling, right? Now you've bought 25 shares and the stock price continues to slide. At $145, you know, it doesn't feel great, but you go in and you buy another 25 shares, right? The stock continues to slide. And again, it's that emotional feeling of, oh my God, I'm actually losing money here, right? And at $140, you go in and you buy another 25 shares. Great. Now your cost base is roughly about $145 per share. Remember, you started at 150. You've got 75 shares of PEP, and the stock continues to slide, right? And this is like a punch in the gut, right? Because now you're continually losing money. You've dollar cost averaged 3 times already, and you're asking yourself the question, should I actually dollar cost any more? But you go with the process and you dollar cost average at another $5 down. Now you are at $135. And lo and behold, PEP stabilizes, right? So now you have 100 shares of PEP. And when you first bought it, it was $150, right? That was your top end buying price, essentially, when you first started buying it. And your lowest buying price was $135. Your average cost for this 100 shares that you now own is $142.50, right? So it doesn't feel so bad anymore, right? You haven't really lost all that much money. Now it's at this point when you actually turn on the revenue stream, right? And what do you mean, Ricardo? Well, now that you have 100 shares, right, you can actually go and sell covered calls against the stock that you actually own. And you can say to somebody, I will rent out these shares for you for roughly about anything between, 50 and $70 per week, right? I'm going to take the lower range here because sometimes it fluctuates with volatility, but I'm going to say PEP is now going to pay you $50 per week just to rent out the shares. And every quarter, they are going to pay you a dividend payment. So let's work out what that actually means for you from an actual revenue generation perspective, right? So if I took the bottom of the range, let's say $50 per week times, and I'm going to take just 50 weeks, right? Times it by 50 weeks. We're not going to do 52. You might miss a week here or there. The market might actually be closed, etc. But times 50 weeks, essentially. What does that actually give you in actual revenue for the year? That is going to be $2,500 for the year that Pep is literally just going to pay you for holding the shares. But wait, that's not actually the dividends that they're paying you, right? That is literally just the covered call income that you're getting from renting out your shares every single week. So besides the $2,500 that you're actually getting from selling covered calls, right, from renting out your shares, you're also going to get another $575 from Pep in the form of dividend payments, right? That brings your total income that you've actually made from just holding Pep, right, to over $3,000 for the year. Now, bear in mind that the weekly payment that you might actually get is going to fluctuate with volatility depending on the time of the market, right? But when you think about it from a return on investment perspective, you have actually bought 100 Pep shares, right? And that was at a cost of $14,150, right? And you're actually making $3,000 return on that investment. So what does that actually mean from a yield perspective? That, people, is a 21.20% yield, right? You're basically beating out the S&P 500 by buying dividend stocks and running covered calls up against them. And this is exactly the strategy that we teach here at Maisha Theory. It's all about the wealth triangle strategy, how to actually buy dividend stocks at the right time, how to sell covered calls against them, and how to actually create appreciation of your actual assets. So that in a nutshell is, how dollar cost averaging actually works. And if I had to paint an analogy behind this, it would be something like you are an aspiring marathon runner, right? And essentially, you have to train every single day to actually be able to run that marathon. And every single day you're putting in the work, you're putting in the work, you're putting in the work, just like you're buying shares and dollar cost averaging, you're buying shares and dollar cost averaging, you're buying shares and dollar cost averaging. And within that period, you're getting stronger and stronger and stronger until you're able to do 5Ks, then 10Ks, then half marathon. And the payout day is when you get to the point where you can actually run a full marathon, right? That's when you have this 100 shares where you're then going to sell covered calls up against them. And if you're dollar cost averaging at the right times, eventually the stock is going to retrace, right? And you're going to land up winning the marathon because now your shares that you've actually dollar cost averaged on is actually more than the average that you've actually paid for your shares. And this has happened to us iteratively. Now, does it happen all the time? Sometimes you have to wait a while, and this is just part of the process. This is the thing that is really hard for beginner investors to actually stomach, right? It's that feeling of the drawdown that you actually see in your portfolio before you actually see a massive spike in it. Now, if you're dollar cost averaging in the right shares, in the right stocks, in the right companies, the stock market is eventually going to retrace. The stock market in itself is a positive drift vehicle. Go and take a look at the S&P 500 over years, right? Sometimes you have a 20% correction in the S&P 500, but eventually the markets just keep on going up, right? And they keep on going up because the wealthy is investing in it and they have assets that they actually need to protect, right? So we are no different from that top 1%. You are no different from that top 1%. It's learning how to take advantage of the stock market. It's building a portfolio that's going to pay you on a weekly basis, that's going to help you retire in comfort, right? It's going to help you do the things that you want to do in your life. It's going to help you live the life that you want to live. So I hope that gave you a good overview of what dollar cost averaging is. And I hope that my analogy rang true as well. So come and join us at Maisha Theory or join our wealth circle community where we share information like this with each other all the time in order to share the knowledge between everybody so that we can all benefit from the stock market. And with that, I'll see you in my next video.